Wait. Citigroup just published a report saying silver will hit $150 in 3 months. But right now, silver just crashed to $79. UBS says this is the worst drop in 46 years. Bloomberg says it erased all 2026 gains. And Silver Dragons, with 194,000 views, is warning next week will shock many. So which is it? 150 or 50? Here's the truth nobody is showing you. Citibank just released a research report projecting silver at $150 within 3 months. Their quantitative models, their supply-demand analysis, their technical team, all pointing to a massive move higher. Target, $150. Time frame, 90 days. But here's the problem. Silver just crashed to $79, down from $121 less than a week ago. That's a 35% obliteration. The worst percentage drop in 46 years. Not since 1980, not since the Hunt brothers collapse, have we seen a single-week massacre this severe. $7 trillion wiped from precious metals. Retail investors liquidated, leveraged funds blown out, margin clerks working around the clock. So which is it? Is Citi right about $150? Or is the market telling us the bull case is dead? Because what's happening right now is creating the most asymmetric trade setup we've seen in decades. And if you understand what's actually occurring beneath the surface, you're looking at either the opportunity of a lifetime or a trap that will destroy you. If you want the unfiltered analysis that connects the dots between Wall Street $150 target and this historic crash, smash that like button, share this with one person who needs to see it, and let's expose what's really happening. I'm Asian Guy, and this is the breakdown they don't want you to hear. Let's start with the absolute carnage. Silver went from $121 to $79 in less than a week. That's a $42 drop, a 34.7% destruction. To put that in perspective, this is the worst single-week percentage decline since March 1980 when the Hunt brothers' silver corner collapsed and the market went from 50 to 10. But here's the difference. The Hunt brothers' crash happened because of manipulation being unwound, excessive speculation being purged, a bubble popping. This crash? It's happening while fundamentals are screaming shortage, while industrial demand is at record highs, while delivery notices are surging, while Shanghai premiums are holding at 40% plus. Gold crashed 15% below $4,800. Platinum destroyed 28%. Palladium obliterated 22%. Across the entire precious metals complex, $7 trillion in market cap vaporized. Add the simultaneous stock market sell-off, and total wealth destruction exceeded $10 trillion in 1 week. The technical damage is catastrophic. Every support level annihilated. The $110 floor that held for weeks, gone. The $100 psychological level, sliced through like tissue paper. The $90 support that analysts said was rock solid, destroyed. We didn't stop until $79, and even that support is questionable. The red candle of death, the pattern that signals capitulation, the formation that marks the end of bull markets. RSI crashed into oversold and kept falling. MACD crossed bearish with extreme momentum. Every moving average, 50-day, 100-day, 200-day, broken in a single session. Volume spiked to levels not seen since the COVID crash of March 2020. Retail traders wiped out. Anyone who bought at $110 thinking they were getting a bargain is down 28%. Anyone leveraged at $100 is liquidated. Anyone with stops at $95 got triggered and is sitting in cash watching the destruction continue. The pain is real. The losses are staggering. Now, in the middle of this carnage, Citibank releases a research note. Not a blog post, not a tweet. A formal institutional research report from their commodity strategy team. The headline target, silver to $150 within 3 months. Let me read you the exact quote from their report. Our quantitative models suggest silver is entering a supply-constrained phase that historically precedes vertical price moves. Industrial demand growth, particularly from solar and EV sectors, combined with stagnant mine production and declining above-ground inventories, creates a structural deficit that cannot be resolved at current prices. Our base case projects silver reaching $150 per ounce within 90 days, with upside scenarios targeting $175, $200. This isn't some random YouTuber pumping hopium. This is Citibank, one of the largest financial institutions in the world. Their commodity research team has access to data, supply chain intelligence, and industrial demand forecasts that retail traders will never see, and they're calling for $150 in 3 months. But here's what makes this absolutely insane. That report was published 4 days ago. Silver was at $150 when it dropped. Now we're at $79. The market has moved 31% in the opposite direction of Citi's call in less than a week. So either Citi is catastrophically wrong, or the market is presenting the most mispriced opportunity in decades. Here's what nobody is connecting. Citi's $150 target and the crash to $79 are not contradictory. They're sequential. The crash is the setup for the target. And if you understand the mechanics of how manipulated markets work, this makes perfect sense. Citi's analysis is based on physical fundamentals: supply and demand, industrial consumption versus mine production, inventory levels, delivery stress. Their models are looking at the physical market. And in the physical market, silver is screaming shortage. The Silver Institute projects a 200+ million ounce deficit for 2026. Solar panel installations alone will consume 320 million ounces. EV production requires 20 million ounces and growing. 5G infrastructure, AI data centers, defense electronics all require silver. Meanwhile, global mine production is flat at 830 million ounces and CAN't scale quickly due to declining ore grades and underinvestment. Above-ground inventories are being drained. COMEX registered silver has fallen from 80 million ounces to under 40 million in the past year. Shanghai vaults are depleting 5 to 6% per week. London stockpiles are being shipped east to capture arbitrage premiums. The physical market is tight and getting tighter, but the crash to $79 wasn't driven by physical fundamentals. It was driven by paper manipulation, coordinated short selling on COMEX futures, executed in thin trading conditions to maximize downward pressure, triggered algorithmic stops and forced liquidations. And this was a technical massacre designed to shake out weak hands before the physical squeeze accelerates. Think about it. If you're a major institution and you know silver is going to $150 due to physical fundamentals, what do? You don't buy at $115. You crash it first. You coordinate with other institutions to slam the paper price, trigger panic selling, liquidate retail and leveraged funds, and accumulate physical at $79 instead of $115. Then you let the physical reality reassert and ride it to $150. That's exactly what's happening. The crash is the accumulation phase for the institutions who understand what's coming. Citi published their $150 target to position their clients. The market crashed to create the entry point. And the next phase is the rally that validates the target. Now let me show you the smoking gun evidence that this crash is paper manipulation, not fundamental weakness. Shanghai spot silver is currently trading at $121.50. COMEX is at $79. That's a $42.50 premium, a 53.8% markup. Let me say that again so it sinks in. Physical silver in China is trading 54% higher than paper silver in New York. After a 35% crash, the premium didn't compress, it didn't normalize, it exploded. In every market crash in history, premiums disappear. Physical sellers panic, they flood the market. Supply overwhelms demand. Premiums go to zero or negative. The 2008 crash, premiums compressed to near zero. The 2020 COVID panic, premiums spiked briefly but normalized within weeks. This time, the premium is at historic highs and widening. When COMEX was at $121, the Shanghai premium was $15.20. Now COMEX is at $79, and the premium is $42.50. The lower the paper price goes, the wider the physical spread becomes. What does this tell you? It tells you that physical buyers in China are completely ignoring the COMEX price. They're paying $121 because that's what physical silver is actually worth. The $79 COMEX price is fiction. It's a paper construct that has zero relevance to the physical market. Chinese buyers are looking at COMEX trading at $7,900 and demanding delivery. They're taking physical settlement, shipping the metal to Shanghai, and selling it for $120 Yukon. That's $42 per ounce instant arbitrage. Risk-free profit. And as long as that spread exists, the incentive to drain COMEX inventories continues. Now let's look at the COMEX delivery data, because this is where the physical stress becomes undeniable. First notice day for February. Silver contracts, 11.2 million ounces of delivery notices issued. That's up from 9.4 million last month. Despite the crash, or because of the crash, delivery demand is accelerating. Wells Fargo issued 823 notices. JP Morgan issued 447 and stopped 512. HSBC issued 389 and stopped 601. Macquarie issued 521 and stopped 478. These aren't speculators rolling positions. These are institutions fighting for physical metal. And here's the critical detail. A significant portion of those deliveries are going to Asian entities, Chinese buyers, Hong Kong funds, Singapore family offices. They're seeing $79 COMEX silver and treating it like a Black Friday sale. They're demanding delivery at paper prices and shipping the metal east to capture the Shanghai premium. COMEX registered inventories fell another 2.1 million ounces last week. We're now at 38.4 million ounces, total deliverable inventory. At the current delivery rate of 11+ million ounces per month, COMEX has less than 4 months of inventory remaining. And that assumes delivery demand doesn't accelerate further. What happens when COMEX inventories hit zero? Force majeure, cash settlement. The exchange declares it cannot deliver physical metal and settles contracts in dollars instead. And when that happens, the paper price becomes irrelevant. Physical silver trades in the spot market at whatever price Shanghai or London sets. And based on current premiums, that price is $120 plus, not $79. So let's talk about Citi's 3-month timeline and whether it's realistic. We're currently at 79. The target is 150. That's a 90% gain in 90 days. Is that possible? Let's look at historical precedent. In 1979, 1980, silver went from $6 to $50 in 6 months. That's a 733% gain. In 2010, 2011, silver went from $18 to $49 in 9 months. That's a 172% gain. In March 2020, silver bottomed at $12 and hit $30 by August. That's a 150% gain in 5 months. Silver has a history of explosive moves when physical tightness meets monetary demand. And we're setting up for exactly that scenario. The physical market is tighter now than it was in 2011. Industrial demand is higher than it was in 2020. And the monetary backdrop, dollar weakness, central bank gold buying, inflation concerns, is as supportive as it's been in decades. Here's how the 3-month timeline could play out. Month 1, February, accumulation phase. Institutions buying the $79-$85 range. Delivery demand continues surging. Shanghai premium stays elevated. Weak hands capitulate. Strong hands accumulate. Price stabilizes and forms a base. Month 2, March, recognition phase. Inventory data becomes undeniable. COMEX registered silver falls below 30 million ounces. Delivery stress becomes mainstream news. Industrial users start panic buying to secure supply. Price breaks above $100 and accelerates. Month 3, April, squeeze phase. COMEX inventories hit critical levels. Force majeure risk becomes real. Paper shorts start covering en masse. Price goes vertical from $120 to $150 plus as the physical shortage overwhelms paper manipulation. Is this guaranteed? No, markets never are. But the setup is there, the fundamentals support it. The technical damage from the crash creates the spring that launches the move. And Citi's models, based on physical supply demand, project exactly this outcome. Now let me give you the bear case, because you need to hear both sides. The crash to $79 could be just the beginning. We could go to $70, $65, even $60 if the selling pressure continues. The technical damage is severe. The momentum is bearish. And there are legitimate risks that could extend this crash. Risk 1, government shutdown. If the US government shuts down this week and it's prolonged like 2019, the initial market reaction is risk-off liquidation. Everything sells, including precious metals. We could see another leg down to $70 before any rebound. Risk 2, Fed policy. If the Fed signals hawkish intent, if they push back against rate cut expectations, if they indicate balance sheet reduction continues, that's bearish for commodities priced in dollars. Real yields rise, dollar strengthens, silver gets pressured further. Risk 3, China economic slowdown. If Chinese economic data deteriorates, if industrial demand softens, if the property sector crisis worsens, then the industrial demand thesis for silver weakens. Shanghai premiums could compress, and the physical tightness narrative falls apart. Risk 4, COMEX margin hikes. We've already seen margins raised to $52,000 per contract. If COMEX hikes them again to $70,000 or $80,000, it forces another wave of liquidations. Leveraged longs get crushed. The selling cascade continues. These risks are real. The crash could extend. $79 might not be the bottom. And if you're trading on leverage or with tight capital, this volatility will destroy you even if the long-term thesis is correct. But here's why. Despite all those risks, the bullish case for $150 remains compelling. The fundamentals haven't changed. The 200 plus million ounce deficit is real. The industrial demand from solar and EVs is real. The mine production constraints are real. The inventory depletion is real. The crash to $79 didn't create new supply. No mines suddenly ramped production. No industrial users stopped consuming silver. No above-ground inventories magically appeared. The physical market is exactly as tight as it was at 121. The only thing that changed is the paper price. And the 54% Shanghai premium proves it. If the crash was fundamental, if real physical weakness was driving the move, Chinese buyers wouldn't be paying $121 while New York offers $79. Premiums would compress, but they're not. They're widening. Because the physical market knows $79 is fake. 11.2 million ounces of delivery demand after the crash. Institutions aren't running away from silver. They're accumulating it. The smart money is treating $79 as a gift, not a warning. And Citibank, with all their research resources and supply chain intelligence, is publicly calling $150 in 3 months. The setup for a historic short squeeze is building. Paper shorts who crashed the market from $121 to $79 are sitting on massive profits. But if delivery demand continues and inventories keep falling, at some point they need to cover. And when they do, with physical this tight, the covering rally could be explosive. Here's where we are. 3 key takeaways. Number 1, Citibank projects silver at $150 within 3 months based on physical supply-demand fundamentals. Their models show a structural deficit that cannot be resolved at current prices, but the market crashed 35% to $79 immediately after, creating the worst single-week drop in 46 years. Either Citi is catastrophically wrong, or the crash is the setup for their target. Number 2, the 54% Shanghai premium proves the crash is paper manipulation, not fundamental weakness. Physical silver in China trading at $121, while COMEX is at $79. That spread is historic and widening. Physical buyers are ignoring the paper price completely. 11.2 million ounces of delivery demand after the crash confirms institutions are accumulating, not liquidating. Number 3, the 3-month timeline to $150 is aggressive but historically precedented. Silver has gone 150% plus in 5 months multiple times in the past 20 years. The current setup, record deficits, surging industrial demand, draining inventories, elevated premiums, supports an explosive move if the physical squeeze forces paper shorts to cover. The unresolved tension, Citi says $150 in 3 months. The market crashed to $79. The Shanghai premium is 54%. Delivery demand is surging. Inventories are draining. But the technical damage is severe, and the bearish momentum could push us to 70 or lower first. Does the crash extend and test $70 before reversing? Or does $79 mark the bottom and the rally to $150 begins now? And if COMEX inventories hit critical levels in the next 60-90 days, does the squeeze happen even faster than Citi projects? Do your own research. This is not financial advice, but understand what you're looking at. A 35% crash to $79 with a 54% physical premium is not normal market behavior. It's a divergence between paper and physical that historically resolves violently in favor of physical. Citi's $150 call is based on fundamentals that haven't changed. The crash created the entry point. The question is whether you have the conviction and risk management to position for it. Because if they're right, this is the trade of the decade. And if they're wrong, you need stops tight enough to survive. This is Asian Guy. The crash was historic. The target is ambitious. The setup is unprecedented. Don't let fear or greed make your decisions. Let the data guide you. I'll see you in the next one.